What's up, YouTube? It's Joe Catalpalia sitting on the couch, making some money investing in fractional real estate online. As has been pretty normal lately, as I was spending some time on Lofty today, analyzing some deals, looking for some properties to buy, and it made me realize, and I actually was talking to one of my team members about this. That sometimes it may come across that I'm like way too negative when I look at properties, right? Like I'm always focused on the downside, focused on, things that can go wrong. We're looking, all of our due diligence is, it's basically geared towards ruling properties out. And you'll see I spend very little time looking at, what's this actual yield, right? I don't necessarily, well, one, I'm buying several properties that show a zero yield right now. Um, I do a calculation to figure out what I think that yield is going to be, but I don't spend a lot of time focusing on that. And I want to explain why. So, one of the things, and I think it's a big mistake a lot of people make on this platform in particular, is to focus too much on this yield. And one of the reasons I say that is because on Lofty, this yield is just what did you get this month? What was your payment this month relative to whatever you paid for that or relative to the price it is today? I mean, that's what this yield shows. When I go into my account, it shows me, what my yield was relative to what I paid for it. Um, but it doesn't tell you anything about, well, what is my long-term yield? And so typically the ones that when you sort this show up on the top of here are the ones that had the perfect month, right? They were full. They had no major repairs and maintenance. And I'm not saying that's exactly what's happening with each one of these, but it tends to be the trend that that's what's happening, right? And so a lot of people buy into these thinking, oh, this is a 20% return, or it's a 20% return, without really thinking about like what's my average return going to be. And if you watch my video yesterday when I was talking a lot about the cap rate involved, that's one of the things that helps me get at, what is my average return going to be? Like I'm looking at how does the property perform um as a property versus with the current financing. And so that's a way to help you figure out in the very long run if things go a certain way what your return is going to be, but it doesn't really address, the issue of risk. And so today I'm going to talk to you a little bit in a little bit more of a theoretical way of, sort of visualizing risk. I think that if you are new to investing or you just want to really find someone who, has just incredible insights into risk, I would encourage you to look for anything by Howard Marks. He's got a lot of YouTube videos. He's got several books. He's a billionaire founder of I think Oak Creek Capital Management or something like that. But just regardless of his success, I think that what really attracts me to his stuff is he's able to. He talks about risk in a way that you'd only see. The only other one that I think is very comparable is Nassim Nicholas Taleb, who his stuff is like much less approachable unless you're really nerdy. Which I mean, I've read all of his books. I can't tell you I fully understand all of it, but it is I think Howard Marks will give you some of the same info in a way that's a little bit easier to understand. But I want to take something that I've really learned from him, or from both of those gentlemen actually, but sort of internalized a little bit different when I'm thinking about real estate. And this sort of goes to explain like the mistakes that I think a lot of people make when they're looking at thinking about the risk of these things. So one of the things you see, like, wait, this is our bell curve, right? And so this curve represent all of the potential results that would happen. And if you think in your mind as far as this is how a lot of people, I think inside they're imagining risk, and this is not accurate, but this is what I think goes on, right? They're saying, okay, that's a 20% return, and maybe maybe the 20's over here, and there's a little bit of room for, I'm going to get a little bit better return than that. I might not make anything if things don't go well. On average, most of the results are going to fall down here in the middle, right? And this is how bell curve results work on just about anything. If you've done a lot of statistics, um, almost always until you get a little bit further along, the assumption is you have a bell-shaped curve. But one of the things that you realize when you start to do things in real life, and if you go a little deeper into understanding how this works, the bell works really good in certain situations, but not necessarily when you're looking at financial things because of how wildly different results can be. And so I think when you're visualizing a specific investment, it should actually looks a lot more like this. You still have your average, because you have all this space under here, your average might actually get cut somewhere closer to here versus, right in the middle of the hump. But regardless of where it is exactly, it gets pulled to the left a little bit because of all the scenarios that could go very wrong, where you go from making no money to losing all of your money, right? And I think a lot of people, even though they understand there's the risk of losing money, when you see a lot of investors do their, best case, worst case scenarios over long periods of time, a lot of times they're not even acknowledging that a loss could be part of that, which clearly it is. I think if you look at Lofty as an example, anybody who bought any of these tokens, right, all of these ones that are less than $50 right now, all of them are losing, even though when they bought them, they were probably under the impression they were going to make a decent return. And so, obviously the idea that you're going to possibly lose money, you just have to, that has to factor into it. And it might be for, remote chances of all these losses, but it does pull your average down greatly to the left, right? Um, I think so. A lot of the work that we're doing, you can spend a lot of time, playing with your model and trying to figure out, am I here or am I here, right? Like, I'm in between these two numbers, but there's not a whole lot of work to be done here, right? Like, you have to be really right to go from 15 to 20, or from, you have to just get every number right. And like when we start to look at, um, the financials tab for some of these properties, and when we start to do spreadsheets, so a little bit what I was going through on yesterday's video, when you realize they have some really garbage numbers that they're giving you here. I just picked out one that I was looking at today that is just horrifically wrong. They don't even have the gross rents calculating correctly because they got a double payment in 1 month. And so, whenever, obviously, this is, as I mentioned lots of times, it's both the opportunity on Lofty, and I think the thing they have that's going the worst for them is that they do have all of these like problems with reporting the data that's coming out. And so it's not easy to look at this property and figure out what's actually going on, because you can see they have their rents way off, but they also have this huge operating reserve replenishment. What's really funny is I was trying to recreate this, and if you just plug in their numbers, you're not getting to this projected annual cash flow. So I'm really not sure what they're doing there. Um, you're not getting there either way. So this is calculating from somewhere else. Maybe this number is closer to correct. I think actually, in the one that I did, it's actually really close to the numbers. When I used what I think is their actual rent, I put some vacancy collection loss. Um, I've used an allowance for repair and maintenance, and I actually came up with a number that was super close to theirs, which I find interesting because I have no idea how they're getting to this. Um, and so, at the current or at the current price, this looks like it's a 14.61% return. But, whether that is true or not, it would certainly do better if you have less repairs and maintenance and less vacancy collection. It can, and as we can see right now, it can do a lot worse, where you have no yield for a long period of time. And so the reason that I bring this up in this discussion, and why I really focus on the downside is, there's all these things that we can't predict that will move the needle a small amount, right? This 10%. But there's a whole bunch of things, like there's a lot of room, right? Like what if, a lot of the things that have to happen to make you lose all your money um, are things that you could avoid, right? I mean, like sometimes there could be some catastrophic losses that you didn't plan for correctly. But in the vast majority of cases, when you've lost money on an investment, it's because you bought in a flood zone and you didn't realize it, or you um, bought in an area that has horrible occupancy and you didn't realize it, right? Like the rent looked good compared to the price, but it was a really bad area, or you paid too much for it relative. It looks good on the surface, but then when you really start to look at the comps, they're all on the other side of some road, or you're backed up to something that's considered a nuisance. You're backed up to a dump, or any number of things. But so most of the time, when somebody loses money in real estate, it's not because of some crazy thing that happened, because often our insurance covers that. And also there's just not that many instances of that, but it's most of the time it's because a bad purchasing decision was made, right? Somebody paid way too much for something. Or sometimes what does happen though is you have a bad manager, they make off with some money. Usually you're not going to lose your whole investment on a property when that's the situation. Um, Especially if you don't have financing, right? Like if it's owned free and clear, like a lot of the assets I like to buy on Lofty right now are the unlevered ones. If you can get, a 14% return on a property that has no mortgage, or you're getting a 20% return on another one. Like here, I'll give you an example. So when we look at these high yields, right? I actually really like this one, but let's see. So this is the one I was talking about last night. They have an incredible yield, but it's really not coming from the fundamentals of the property, right? And so like it's coming from having a very it's very highly levered. It's like $297,000 in debt on 360,000 in their original purchase price, and now it's more levered, but it's much higher assumed price based on the outstanding tokens. But so that so to get this 20% return from high leverage, right? You can compare it if you're investing in the universal lending DAO. I think we talked about this before, though. I think this number should really be closer to 1350, but this is an unlevered number. But if you look at the one we were just looking at, right? Once this is occupied and has gotten it's occupied, but once it's gotten to the point where they've replenished the reserve, which it appears that they're doing, and I have the wrong thing open there, right? Like it's almost replenished, but once that's replenished, this property is going to be spitting out somewhere in the neighborhood of this, based on the numbers that I was using, 14.49%. And that's that's with no debt on this property. I mean, this is owned free and clear. And so if I can have a 15% return with absolutely no debt versus a 20% return that comes from, a massively levered property, if everything else were equal about those two properties, it'd be a really easy choice. Now, one is in a much nicer market than the other. It's a newer home. So, I'm not saying one of those definitely is a buy and the other isn't. I'm just saying, the risk profiles of the debt structure is much different. And then, so you have that issue. Uh, those are the times where you lose all of your equity happens much more often when you have debt than when you don't, right? Because if you don't have any debt and you don't have a tenant for several months, the only thing that you have to worry about is your property taxes and insurance and maybe some utilities. If you have a mortgage, you have to figure out where that mortgage payment's coming from, right? And so it's a significantly higher chance of being in this uh, place where you lose all your money because your equity makes up a smaller portion of the property. But also too, if you paid too much, if you um, just bought a property that you didn't get a good inspection done, and so there's a lot more problems than you expected. Again, if you own it free and clear, you're probably not going to lose all your money because you just end up dumping more money into it, but you will you can end up with a very low return. But by levering it, you know, it could make it a lot easier to switch into that negative. I don't want this discussion to come off as me saying I think you should own everything free and clear because I've been someone who's always used debt. Um, but I want to just make it clear that, you know, by moving from, say, I'm going to go from 14 to 20, right? Like I'm making this move, that's getting rid of that's opening up the possibility of all these losses, right? Like where you can go, okay, maybe the most I was going to do is a zero or a very small loss, but it opens up the potential for a total loss, because it's relatively easy to wipe out your equity once you have debt that represents 80% of the property or something like that. And so there are times where I think it makes a lot of sense to have a levered property. And some of the ones that I bought do have debt, but they're much more conservative debt where, um, the property should be able to sustain it itself and for a long period of time. And if I can do that and still get a good return, make my return a little bit better, but I'm not just opening the floodgates of all of the potential losses. I'm much more concerned with that, right? And so that's why you'll see me spend all this time focused on what could go wrong, what's wrong with what are the, does it have, can it cover its debt? Is there something wrong with the location? Is there something wrong with the property? What is the market like, right? Like the other way that you can really have a problem is if you're in a market where your property values or your rents are going down over time, or even if they're not going down, if they're not going up, keeping up with inflation, you end up losing value in real dollars, right? And so if your money's worth less, even if you bought the property for 100,000, in 10 years from now, you can only sell it for 100,000. Really, you've lost money compared to inflation. And so, you do run that risk in some of these markets. And some of the markets that I bought in, I think it's a possibility, which is why um, one of the things that you can do to really avoid those, like when I'm um, showing you like the discounted tokens, yes, I think that is going to make for a better return because, when you can sell it, you can make more money. But the other thing it does is it really helps you cut off the negative side, because if you are already getting it really cheap, the chance of selling it for a loss in the future is significantly lower. So I mean, that's my whole thing. I think just to kind of recap, I think this is the mindset that this is what goes through, even if you acknowledge that there is the potential for loss. Most people, when they put their spreadsheets together, if you look at their range of outcomes, they almost never fall. You almost never see a negative number in their range of outcomes. And if it's not, you're completely ignoring, um, you know, a huge chunk of realistic potential outcomes. And so even though the prevalence of those outcomes might be very low relative to everything else, the existence of having some of these giant negative events relative to the small positive returns makes me just rule out certain properties that otherwise might look really attractive, right? And so that's why one of the things that I've been asked quite a few times is, some of these look like the top performers. Why don't I own many of these? And I bought some, right? I own some of Ridgetop. Let's see what else. Some of them. Let's do it the other way. Buy. Uh, I own some of 90 Madison. This one doesn't look like it's a huge percent return, but it's an accounting error the way Lofty's doing it. It's making a lot of cash flow, but they're actually paying it towards debt. So both the cap rate and the yield are just not being shown the way that I believe reflects reality. Um, I guess those are the two that I've paid up for quite a bit, and then I have some of this one, which the return is just recently gone down to, well, the return's 15%, but at the price I paid for it, it makes my return more like 17 or something. And that's one of the things that gets a little confusing when you start to look at this compared to the way they are in your account, because I think of this as being a 17% yielding property, but it's because my average purchase was like 44 bucks. But that's the whole point of, so I am buying some of them that have these higher yields, or, some of mine are giving me a higher yield, but a lot of times, um, I don't want to stretch on the value of the property just to get this yield. Um, I hate to keep pointing at this one because it's one that I think, it does still seem too pricey to me, but I think that there's good value there. And this is one that I actually like, and it's very close to the value from the appraisal and from what it was originally listed at. And it has a high cap rate, right? And so, yes, there's yield, like an increased yield from the leverage, but it's not so much, right? Like, I mean, it's less than three times the cap rate. But like when we look at this one, we're at four times. This is the one I was talking about last night, which is even. I mean, this is five, more than five times. Your yield is more than five times your cap rate. Like that is uh, the chance of this one over the long run not being here and being somewhere, you know, much further down, in my mind is much higher. Now, one of the things, to go into this just a little bit more, and then I'll wrap it up. But I think that, and this is definitely something I get from Howard Marks as well, is as much as I can point on the chart and show you the realm of potential outcomes, I don't try to model it, because one of the things he talks a lot about, and I just very firmly believe, is there's no way for us to accurately put a number on risk, right? Because part of it is what we don't know, the unknown unknowns, right? Like the things we don't even know to look into, the things that we did look into but came up, we're wrong about. There's no real way to quantify it. And one of the real interesting things he talks about is even after the fact, once you know the outcome, you still can't quantify what the risks were, because you don't know which risks were out there that never actually impacted your property or your investment or whatever it is. And so that's something that is why I take an approach where I'm looking at a property. Yes, I want the yield to be, um, above the average of the other yields or around the average of the yields of the properties that I'm looking at. But I'm much more concerned with not buying a loser than I am trying to pick the one that just has the absolute highest yield, because I don't believe that's the way. It's not going to. I don't believe that's going to turn into the best return in the long run. And it's because you end up throwing too many of these results in there. You might get lucky and have some of them, remain perfect and stay high. I think the most likely result is a lot of those really high yielders come down over time, especially because the way that platform works, you run into the debt dilution. And so then you can't keep those high yields up, unless you just don't pay down the debt at all. Um, but it is, there's uh, there's just like I think these numbers they're all fuzzy anyway, as I mentioned, like they change every single month, and so what this number is this month doesn't necessarily say very much about what my long-term return holding this asset is. And that's why I want to look at, okay, what are all the risks? And then I want to look at the cap rate and understand, like, okay, what's the performance of the property? As far as like if I'm looking at the rent and the price and, expected vacancy and repairs and maintenance, what is that property going to look like over the long run, unlevered, right? That's what we're looking at cap rates for. And then, then I can start to really understand like I'd much rather pick properties by cap rate than by yield to a certain extent. Now, it changes because I do like to use debt to increase my returns in a way that I'm trying to not lever up so much that I'm greatly increasing my risk. Um, but it is, even so, even when you come on here, though, you can't just look at these cap rates because you can see they're annualizing. Like, so for example, this one is just annualizing a no income month, but it's really not no income. It's going to be really slow to load. But what they're actually doing, there is income in this month, but they're putting that money towards the operating reserve replenishment. And so it, that doesn't actually work out into, I mean, it's just not how, it's not how cap rates work, right? Like, okay, they made that money, but they were putting it into a reserve, so we don't have it. So, that's part of this being fuzzy numbers. But again, as much as it's a little bit annoying to deal with, it is why there are fantastic opportunities. This is a property that I've been, picking up tokens for every time they hit a price that I'm happy with. I do want to remind you though, just because I'm buying certain properties does not mean it's the right answer for you. You want to do your own due diligence, and also and just because this is the platform that I'm spending the most time on, again, you want to make sure it's one where you are comfortable with the risks of this platform, right? Like I decided I really like Lofty. Could I be wrong about its safety? Certainly, it is on the Algorand blockchain, and the research I've done on that, I feel pretty good about how the contracts work and how the ownership structure is, with the DPOs. But it doesn't mean that I'm right about that, and so that's something that you want to look into, right? Uh, so you can watch some of my other videos where I talk about the platform itself and that risk and the risk of some of the other ones that I've looked at. The other one I always mention is ground floor. Um, on those ones, uh, you do have this same spectrum, but your chance of 100% loss on there because you are a lender, um, and your option is to foreclose sometime in the future. Um, the chance of being in this area over here on that platform, maybe the zero, maybe a small loss, but being close to this 100% loss, I think is just extremely low. And that's one of the reasons I like that platform, even though their average returns are not amazing relative to some of the lofty ones. I really just like how that plays out. Um, I'm doing a little bit of both because I think that there's opportunity to use both sides, to take a little bit more risk on this platform and hopefully get a little bit more of an outsized return, and balance that out by putting a significant amount eventually onto ground floor, where I think that my range of returns is gonna, it's gonna be much tighter. Like I think there'll be far fewer losses on there, and there'll be slow pays and there'll be ones that take a while to foreclose, and definitely potential for loss on there too. But I think that the structure of the being in the position of a lender is just a better, typically less risky situation. But obviously, again, on that one, you want to do your due diligence as well. Um, all the ones that I mentioned, I do have links in the description below if you want to sign up if you haven't done that before. Read their terms of service and everything as far as like what, they're giving you some free money, but you have to do certain things, and I don't know, there's terms and conditions. And the other thing that I always forget to mention until the very end, if you don't mind liking and subscribing, that would be fantastic. If you like more of this, like sort of theoretical thought about real estate and investing, let me know. I've been trying to do a lot more of the nuts and bolts stuff, but I think a lot of the questions that I get um, spring from the fact they come from the fact that I think about investing in risk much differently than I think a lot of maybe more novice investors do. And because of that, um, a lot of that's just taken for granted in my approach to looking at properties. And so I think the more that you can sort of internalize what risk really is, what what your range of potential outcomes actually looks like, and what the impact of some of those catastrophic losses looks like on your overall portfolio. I think then it becomes a lot more clear why I do, focus so much more on avoiding the downside than chasing yield, right? In any case, I think that's all I'm planning to share for today. So until next time, I am going to keep making mistakes so that you don't have to.